We'll begin our session. Ladies and gentlemen, good afternoon. I'm Alex Pollock, a resident fellow here at AEI. I have the honor of chairing this outstanding panel of experts, and I have the pleasure of welcoming all of you to our conference on bubble trouble. Is this the beginning of the end at long last? In other words, have we really reached the bottom of the great bust which followed inevitably from the great 21st century bubble? Turns out that in the 21st century, we were no smarter than the people of previous centuries about getting ourselves into financial problems. We should remember that the bubble was actually a compound bubble. It has at least three, actually more than three, but at least three parts, all of which we'll discuss today. Of course, a housing and housing finance bubble, a simultaneous commercial real estate bubble, and an overlapping European government debt bubble. U.S. house prices peaked in the second quarter of 2006. Now that was nearly 6 long years ago. The good news is that according to Carmen Reinhart and Kenneth Rogoff, the average duration of the bust which follows a housing bubble is 6 years. So if we hit the average, we should be coming to the end. But of course, if 6 years is the average, it means that some things are longer than 6 years. But at least in historical terms, we're someplace in the range of the average duration of the painful bust that follows the exciting bubble. Now, as I mentioned before, we really had a double bubble because commercial real estate in this country also had a bubble. Commercial real estate prices peaked in the fourth quarter of 2007, so that's more than 4 years ago. Commercial real estate prices fell faster and quite a bit more than house prices did. Have they reached the bottom? That's one of the things we want to think about today. So now we have to add the European government debt to this compound bubble. In January 2010, Desmond Lockman, who is at the opposite end of this table, published his first article predicting that there would be a crisis in Greek government debt. So that's more than 2 years ago. As we all know, the Greek government has now defaulted on its debt. Very large write-offs have been taken by at least its private creditors. And what happens next? And what about Portugal and Spain and the debt of those governments? Well, as if to help set up our conference, the CEO of J.P. Morgan Bank, Jamie Dimon, said yesterday that the U.S. housing market is very close to a bottom. And already there are signs its improvement is going to give a boost to the overall economy. 2 weeks ago, as if to help publicize this conference, Barron's magazine ran as its cover story an article on housing called Ready to Rebound, in which it discussed, after falling 34% in the past 6 years, housing prices should now be recovering in 2013. Well, are these prognostications right? Undoubtedly, our panel will tell us. Serious delinquencies in mortgage finance. Serious delinquencies means loans delinquent 90 days or more and loans in foreclosure, peaked in the fourth quarter of 2009. That's now more than 2 years ago, and they've been falling since then, but they're still at a high level, and mortgage credit is ever more burdened with legal and regulatory risks. Bank failures, of which there have been more than 400 in this cycle so far, continue but at a slower pace. Well, how do we put all this together? Professor Robert Shiller of Yale, famous voice in house price discussions and inventor of the Case-Shiller house price indices, is a good intellectual hedger. He says, while housing data show signs of improvement, the signals are still very mixed. Quite a courageous statement. I'm sure our panel will be more forthright than that. But are mixed signals, as they may be, a sign of the bottom? What does the next year or so hold for the aftermath of the vast compound bubble? Is it really the bottom? Are we looking at an extended sideways movement, perhaps a bumpy sideways movement? Are we going to see the emergence of further problems, further crises or scandals, and maybe slipping further down? Or are we really at the point where we can expect a cyclical recovery, at least in some of these sectors? How should we think about all this? How do we even frame the way we proceed in analyzing these questions? Well, you are about to hear. So let me introduce our panelists in the order in which they will speak. First will be Desmond Lockman, previously introduced, who is an AEI resident fellow. Desmond has been correctly pessimistic since early 2007 and practically clairvoyant about the development of the European sovereign debt crisis. It's time for another cheery Lockman update. Previously, Desmond served as a chief emerging market economic strategist at Solomon Smith's Barney and as deputy director in the International Monetary Fund's Policy and Review Department. He writes on economic and financial policy, monetary reform, exchange rates, central banking, and the U.S. and European financial outlook. Our second speaker will be Tom Zimmerman, who's next to me. Tom is a managing director at UBS, where he's managed research on asset-backed and mortgage-backed securities for 12 years. Before joining UBS, he managed research groups at Prudential Securities and Chemical Bank and was a vice president in the mortgage research department of Salomon Brothers. His research appears in numerous fixed-income publications and industry reference works, and his research team is consistently ranked first in institutional investor surveys of fixed-income analysts. And we are delighted that Tom has been an AE regular at these conferences we have had on the deflation of the bubble since 2007. That makes 5 years. Our third speaker will be Mark Fogarty. Mark is the editorial director of the Mortgage Group at Source Media Publishers in New York, where he's worked for 27 years and seen a lot of things come and go in the mortgage market. He oversees all the company's mortgage publications and websites, including National Mortgage News, Origination News, Mortgage Servicing News, and Mortgage Technology, and chairs Source Media's mortgage-related conferences. And Mark has recently published a book of poetry, which I very much enjoyed. No one is better able than Mark to feel the pulse, or lack of one, in U.S. real estate financing. Next will be Chris Whalen, Senior Managing Director of Tangent Capital Partners in New York, an investment bank to companies in the financial services sector. Chris is vice chairman of Lord Whalen and edits the Institutional Risk Analyst, excuse me, a weekly news report and commentary on global financial markets. He's a fellow of the Networks Financial Institute at Indiana State University, a member of the Professional Risk Managers International Association and of the Global Independence Center in Philadelphia. Chris is the author of the book Inflated: How Money and Debt Built the American Dream, and Chris and I together dreamed up our first conference on the deflating bubble now 5 years ago, as mentioned. John Macon, a resident scholar at AEI, will be our last speaker. John has been an advisor to the U.S. Treasury, the Federal Reserve, the Congressional Budget Office, the IMF, the Bank of Japan, and me personally. He joined AEI in 1984 after a distinguished career in academic research, including his book, The Global Debt Crisis, published in 1986. And I keep telling him he needs to write a 2012 sequel, The Real Global Debt Crisis. He's the author of numerous books and articles on financial, monetary, and fiscal policy, and writes AEI's insightful monthly economic outlook, which you should all be reading each month. Each of our panelists will speak from 12 to 15 minutes. After that, we'll give them a chance to respond to each other or add something to their comments if they want. We then will have a surprise guest speaker, and then we will open the floor to your questions. And unless you run out of questions before that, we will adjourn promptly at 4 o'clock. We look forward to a highly interesting discussion, as usual, with this group. And Desmond, you have the floor.
Thank you very much, Alex, and thanks for the introduction. I'm not going to leave you in suspense as to where I stand. That I think that what we've got in Europe, as the title suggests, is the calm before the storm, that I don't buy the view of European policymakers and the ECB that their LTRO program has finally put the crisis behind them, that we've seen the worst, as a number of policymakers in Europe now seem to be saying. What I think might be worthwhile doing is just reviewing what occurred. Plenty of stuff did occur over the last 6 months since this last time we had a seminar, but I think that a lot of things that have happened are indicative of a currency union that's in the process of unraveling, although there was one big development that is really slowing the pace at which this is occurring. So if we look what's occurred the last 6 months, like Alex mentioned, Greece defaulted in a major way on its debt. They wrote down the present value something like 74% on its private sector debt. The economy is in a state of collapse. The politics is totally dysfunctional. Even with this new write-down, everybody's anticipating that further write-downs are required. And the question is, what happens over the next year? Can they really stay in the euro? The second thing that is major that occurred is that the crisis really spread to Italy and Spain. Bond levels got as high as 7%, in the Italian case, made people think that we were very close to the abyss in Europe, and really got a response from the central bank. Right now, Italy and Spain are clearly in recession, and I'll talk a bit more about that later on. What we've also got is signs of a credit crunch in Europe. The banking system is really cutting back on credit. They come out with numbers this morning showing that February credit is down, despite the LTRO program. We've also had a fiscal compact that, in my view, is an exercise in economic insanity, which I will talk a bit more about later on. And the last thing that is really very important, and that is giving everybody a lot of hope, is that the ECB launched this LTRO program where they pumped in 1 trillion euros in a 3-year liquidity operation, refinance operation. And what that has done is it has brought calm to the market. This chart really just indicates where the Italian bond spreads were in December. They came down, they were around about a peak of 7%. They've come down to below 5%. They're edging back up now. The LTRO drug is had its effect for 3 months. It looks like it's wearing off already. But the two things that the LTRO did in a positive sense is they calmed these markets down, and they averted what would otherwise have been a massive funding crisis for the European banks. So the European banks aren't going to suffer from a liquidity crisis. What the LTRO program didn't do is it didn't solve the capital problem of the banks, the capital shortage problem of the banks. So what you're seeing is those banks have got capital shortages that I think will be exacerbated as you go into recession when you have additional loan losses. But what you're seeing is banks already cutting back on credit in Europe in general, in Italy and Spain in particular. This chart is just showing what's happening with the bank's corporate lending. The other thing that the LTRO program didn't do is it didn't get rid of the basic problem that we've really got in Europe, from an economic point of view, and that is the twin imbalances that I've spoken of before, that you've got a public finance imbalance, you've got very large budget deficits, with a 10% handle in some cases, and you've got very high public debt levels. That's the one problem. The other problem that you've got is that you've got a competitiveness problem, an external problem. Countries within a currency union have lost a huge amount of competitiveness, and the issue is how do you get that back? If you try to go in for deflation, that might solve that problem, but then it exacerbates your public finance problem and your public debt problem. And if you try to deal with your public debt problem through fiscal contraction, what that does is it drives the economy deep into a recession, and you get yourself into somewhat of a vicious cycle. So what the Europeans, in their wisdom, have done is they've conditioned any lending that they're making to the periphery on this fiscal compact. And not only have they got a fiscal compact, but they're enshrining this in a treaty. So I don't know how you back off this when you see that it doesn't work. And what this fiscal compact is doing, the essence of the fiscal compact is they're obliging countries to commit themselves to balanced budget amendments, to pass balanced budget amendments that would have a structural budget deficit of only something like 0.5% at the end of the process. But I think more tellingly, what they're doing is they're obliging the countries to commit to budget adjustment programs over the next 2 years. Now, my problem is that when I see this, what these commitments to these programs are doing is they're requiring of countries like Ireland, Portugal, and Spain to do 3 percentage points of GDP adjustment in a recession, not only in 2012, but in 2013 as well. In Italy, it's a little bit better. It's only 2 percentage points of GDP. Just to remind you that in the United States in 2008, 2009, the Obama fiscal stimulus, which was the largest fiscal stimulus in peacetime, was 2 points of GDP a year. Here in Europe, in a recession, what we're doing is the interesting exercise of trying 3 percentage points of GDP fiscal adjustment in a recession. Now, I'm skeptical that this works, that I think that what this does is drives Europe ready into a real recession. And part of the reason is, the 3 percentage points of GDP fiscal adjustment by itself is very large, but what is happening is it's occurring with the economies, as this chart would indicate, the economies are already in a weak state, the numbers coming out. Italy, for instance, the last 2 quarters have been very negative, and now they're going in, cutting the budget deficit by 2 points of GDP. But what else is occurring is that the external environment, Germany and France, aren't growing anymore, that they slowing down abruptly. So the external environment in which this is occurring is bad. You've got credit contraction, which is going to work in a pro-cyclical way. As the recessions get deeper, you're going to have loan losses. The credit is going to be driven down further. And countries like Spain and Ireland are in the throes of a housing bust. So I don't see how this isn't going to lead to a recession, not simply in 2012, but you'll get the deepening of the recession in 2013. And we seem to have forgotten about Greece's experience. As you go into recession, you lose your tax base, your budget deficit doesn't meet its target, your debt levels rise because you're dividing by a smaller number. And then what your partners do is tell you, well, why don't you try a little bit more fiscal tightening, to correct for those slippages, and then you get very surprised when you get a political backlash about it. So I think that that is really the path on which we're going in Europe. Just as an aside, I think that Greece can still be a very big problem to Europe. Like I said, politics looks pretty dysfunctional to me, that the 3 parties on the hard left are now polling as much as the established parties, and you're going to have 8 parties in the Greek parliament as opposed to 5 before. So implementation problems are going to be huge, and I think that the Greeks will eventually walk. Portugal is not far behind Greece, just in the way in which that economy is tanking and the amount of fiscal tightening that they have to do. I think that the real area which is going to decide which way the euro goes is Spain. So I just want to say a word or two about Spain, just to emphasize that the policies, the numbers just don't add up in Spain. While Spain might have a relatively low public debt to GDP level, its overall debt in that economy is huge, so that they're like 360% of GDP. So what you've got is, in addition to the budget tightening, you've got deleveraging going on in the private sector. And what you've got is the slight problem of a housing bust. This housing prices now are falling by 11%. And when I look at charts, this chart is put out by officially, on a roadshow, the Ministry of Finance or the Spanish bank indicated that property prices in Spain, in a worst case scenario, could easily have to fall another 30 or 40%. So I just don't get it. How, if you're going to be reducing your budget deficit from 8.5% of GDP in 2011 to 5.3 in 2012, that's like 3.25 points of GDP adjustment at a time that you've got a housing bust, at a time that your banks are pulling back on credit, at a time that your external environment is not good. Spain is going to go really deep in a recession. I feel that I'm not out there alone with this view that Spain and Italy are going into recession. This is the IMF's official forecast. They're looking at 2012. The Italian economy is going to contract by 2.2%, and Spain going to contract by 1.7%. The IMF then thinks things stabilize, that it's basically flat in 2013. I just don't buy that. If the policies that got you deep into the recession in 2012, you're going to repeat exactly the same kind of policies in 2013 in worse circumstances. I'm not sure that I see that the economy rebounds. I think that as soon as this occurs, we're really going to have a real test on Spain. Italy, they're in a debt trap. They don't grow. Italy, I think, is a very much better credit than Spain, but it's still very troubled, because once again they're doing the fiscal adjustment in a weak situation, so they're going to have a problem with the debt. So just to go to my last point, just in terms of where I see this going, I think by the time we come back here in October, if we're all around, we come and discuss what actually occurred, I think that we're again on the way to another bout of real crisis in Europe. And my expectation is that we're going to see a repeat of what we've seen so far, is every time we approach the abyss, the ECB comes there with its bounty, manages to kick the can down the road, just so we get by the French election in May 2012, the United States election in November, the German election in 2013. So I think we'll get an exercise of kicking the can forward. The only thing is that, as Greece and Portugal come apart, and as the program shifts to Spain and Italy, which are by far bigger economies and that are going to take a lot more to hold together, we're kicking the can down the road. But my view is that the road is getting ever shorter, and I wouldn't exclude the possibility that, we see a country or two leaving the euro within the next 12 months, and that's going to cause huge problems, for the ECB that we can discuss later on. Did I hold the time?
You did excellently well, and now you all know what I mean by a cheery Desmond update.
I deliberately gave my base case without talking about the downside risks.
Thank you, and that brings us to Tom Zimmerman. So you get to be upbeat, Tom, relatively speaking, at least.
That's not hard to do after Desmond. That's it. Just a second, we'll get slides up here. Looks like it. Let's see if it works. Yeah, it works. Fine. Great. Thanks. So where are we in this cycle? Clearly, we've got some more positive signs in the economy. That goes without saying, right? So, and in the housing market, there are some, do I dare say, grass shoots, green shoots coming up here occasionally. You hear about bidding wars in some parts of the country, but that's few and far between, and pretty anecdotal, I think. And if it weren't for the rest of the topics on this slide, I'd be a little more positive. But so my best guess is that, when Alex talked about how long it takes to recover from a great bubble, I think this is certainly not a normal recovery, and I don't think it's going to be the average of the bad ones. I think this is a super mega kind of thing like the Great Depression, and it's going to be longer than 6 years before we get to the midpoint. So that's my own sense. And why do they say that? Consumers have delivered, maybe halfway there, I don't know, something like that. But look at the state and local governments. I mean, they've done a little bit, marginally. Rhode Island, great, give them hurrahs. Andy Cuomo, forget it. I mean, he's trying a little bit, but he's not done very much in terms of what faces New York State. And Jerry Brown, I don't think so. I think we have a long, long ways to go to get those state and local budgets in any kind of a reasonable shape in terms of the pensions and the health benefits, et cetera, we all know so much about. Federal government, they haven't even begun that one, right? So that hasn't even started. So we talk about what's going on in Europe, but we haven't even started here yet. So the problem with that is that once they do, the taxes that have to be raised and the services that have to be cut back, it's not going to be very positive to the housing market. So I don't see, they do interact. And so once we come to grips with this deficit, both at the state and local and the federal level, I don't see where the consumer has that kind of power to really drive this market like they, quote, used to in a normal environment. So I don't see it collapsing from here, but I certainly don't see it recovering for a much, much longer time than, quote, even an average of a bad cycle would be. And then finally, not finally, but what Desmond just said about what happens in Europe, clearly there'll be a feedback from that. That's not going to go unnoticed in our markets. And then finally, what I'll spend more time on is the housing finance situation in America is still dysfunctional. That's a kind way to put it, I think. And so without that improvement, I don't see how you really get a housing market moving. But now here's the overall credit picture for the consumer in the U.S. Mortgage market debt is down. Other consumer debt on the lower line on here started to come down, and now it's going up a little bit. So a little bit of improvement. You compare that to the gross national product here in the States. We peaked out for total debt at about 98% in 07. We're down to about 85% now. I think you got to go to 70 to get back to some sort of a normal place. So in terms of this chart, maybe we're halfway there. We might be in a normal kind of so maybe halfway from one particular measure. Here's an interesting chart that the New York Fed puts out on a quarterly basis about consumer debt. What's interesting about it is that up until the last couple quarters, they didn't include student loans. Now all of a sudden, student loans have become the new buzzword out here. Oh my God, do we realize how big they are? Oh no, oh my God, is this the next subprime? So I don't think it's not as big, obviously, but it's pretty big. It's bigger in credit cards, it's bigger in auto loans, it's like $1 trillion. It's big. The only similarity, I think, between the subprime world is that I don't think any of these administrators in these universities really get it yet. I don't think they understand that there is a credit crisis in this system, and when that credit crisis starts to hit and politicians start to say, maybe we shouldn't be funding all this money to go into those kind of wonderful ivory houses that our kids are going to school in, maybe we ought to double think that, but there's no sign of that yet. So I'd say the student loan industry is like the subprime was in 2007, it's about the same, something like that. So back to the housing market. Clearly, this is, hard to see here. Yeah, this is the new home sales. Well, we all know that. That's very, 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 very depressed, right? That's not going to come back for a while. Existing home sales. Existing home sales. Let's come back a bit. Not very much. Oh.
There we go.
Oh, thank you. That's good.
That's helpful. Good idea, Chris.
Thank you, Chris.
If the numbers are bigger, they're better, Tom.
That's good.
It's like an F8 or something, right?
You're good. Let's
That's okay.
leave it and we'll continue.
Yeah,
We'll make do.
that's good enough. Okay, so anyway, so existing home sales up, but not a whole lot. Price indices has been negative for quite some time, the past year or so. It's not as negative as it was. That's positive, but not fantastic. Affordability is off the scale, good. But then the problem is, so why is the market so lousy if the affordability is so great? And we know a lot of the reasons. They're pretty familiar to everybody by now. 25–30% of homeowners are underwater. FICO scores are lower than they were at the beginning of the cycle. Tougher lending standards by everybody. Everybody's tightened up dramatically, and we'll talk more about that, and that's really where why I think this is going to be a very, very, very long recovery. Big inventory of unsold homes and this big backlog of delinquencies, which will overwhelm us, not overwhelm us, but was really the heart of the problem. This is something Lori Goodman put together. It's not been updated. This is last June. But basically what she's saying with this chart is that we've got anywhere from 8 to 10 million homes which are likely to default in the next 4 or 5 years. That's like 15 to 20% of the people who have mortgages in America. This is a chart by Chris Flanagan at Merrill Lynch. It says very much the same thing, and he's got like a timeline on it. So you take a look at that lower next to bottom line, which says liquidations year by year. It's running like, 1.5 million liquidations a year. The problem is it stretches out through 2015. That's the problem. It's not that it's going to disappear tomorrow. When you put this many distressed homes into the marketplace, I find it very hard to see the housing market recovering with that kind of pressure on it. Distressed homes sell for anywhere from 15, 20, 30% less than a non-distressed house. You're going to see a lot of distressed house sales in the next 3 or 4 years. Hard to see a strong recovery in that kind of a market. This is on the ground, what's happening in California and Florida, and it shows a timeline, how long it takes to do 2 things. First, it shows how long it takes to take a loan from foreclosure and put it into REO. Then it shows how long it takes from REO to liquidate that property. And the bottom 2 lines are the REO to liquidation. Once the bank has control of the property, now it takes about a year to get rid of it. And that's kind of stabilized the past year or so. But the other lines, which show the 2 lines for California and Florida, which show how long it takes, once it goes into foreclosure, how long does it stay in foreclosure before you get title to that property? That's going from less than a year to like 2 or 3 years. And so if you wonder what's going on in the foreclosure world, this is a good chart of what's going on in the foreclosure world. This is really deadly from a lot of respects, both for homeowners, for the industry, for the banks, for everybody. And one of the questions, what's going on, here is, I don't like to read things, but I will read this. This is from March 23rd, Inside Mortgage Finance. It says, Alfred Pollard, General Counsel to FHFA, he says, state and local officials have been very active in adding or amending laws related to foreclosures, he said. By one estimate, since 2009, state legislators have introduced over 550 bills in this area. Legislation in these areas can have detrimental consequences for the mortgage finance system. In sum, both the substance of laws and the volume and layering of legal requirements contribute to the problems of orderly and less costly foreclosures. I mean, there's no question that part of this chart is a direct reflection of what's going on at the state and local level in terms of all these politicians who will get points from their constituents by saying, we're going to help you when it comes time for a foreclosure. The problem is For the system as a whole, it's devastating. It's very, very deadly for the system as a whole. This was a comment from an official at FHFA. Of course, when you turn it around and said, well, what about the federal government? What's it been doing? You could say exactly almost the same thing. So both at the state and local level, the federal level, all these changes that are going on in terms of mortgage servicing, mortgage origination, are having a deadly impact on the mortgage market. And I don't see any light at the end of that tunnel. So housing finance, it's almost impossible for many Americans to get a mortgage right now. If you have friends who try to refinance, take out a new loan, et cetera. And part of what's the main thing that's going on here is that the banks, who are the main originators of loans, have been hammered so much by state attorney generals, by investors, by the federal government, by the Justice Department, that mortgage origination and servicing has turned into an enormously high-risk game. You have to be out of your mind to get into that game right now. Absolutely crazy. And they're not. They're exiting it. They're going. They're disappearing. And you wonder so I don't see how you get a viable housing market without a viable housing finance market. I don't understand that. I don't understand it. So I don't think it's going to happen. Recently, the federal government has done a few things, right? We know this is what happened since we spoke last. This is new information, so to speak. You've got a $25 billion state attorney general settlement. Marginal impact, I don't think it's going to do a lot. A few 100,000 people make it help a little bit. Those are the people who are already underwater, having trouble, et cetera. They may get some principal written down, but in terms of total foreclosures and problems, you'll solve some of those people. Some of those people will come back in default anyway. I would guess 25 to 30 or 40% will still default, even though you help them with their principal balances. We have HAMP's been improved a little bit. That was always a marginal program, remains marginal. HARP, which is a program for Freddie Fannie loans for people who have LTVs of 120, 125, 130, and it didn't work the first time around. This time around, it's worked wonderfully. The new HARP program has been put into effect, and it's really had a great impact. The banks, with the new program, lose their liability to reps and warranties when they refinance. So lo and behold, when you take away the impact of the possible reps and warranties, i.e. Freddie Fannie putting these loans back to the banks, if they refinance these people who have 125, 140% LTV, they raise their hands. The current data shows that about a third of the refinance activity last month was HARP. So it's really working. So we're getting some refinancing. Something's happening. So there's a little bit of good news here amongst the bad news. You've probably seen or heard about this program that Fannie's going to try to roll out, which is an experimental program. A lot of talk about it, a lot of buzz on Wall Street. REO to rental. Okay, so no longer do you foreclose on these people. You try to sell the loan, you sell the mortgage to or the property to an investor. He rents that property either back to the current owner or to somebody new. I think this, again, will be marginal. I think there's a lot of talk about it, a lot of buzz about different equity, private equity funds and hedge funds getting involved in this. My guess is this is a very, very, we can talk for a half hour just about this, but I think it's going to be, again, a marginal impact. And finally, the balance reduction issue, which is this Ed DeMarco at FHFA versus the entire world. This poor guy. I really feel sorry for him. I mean, he's got the Obama administration beating up on him. He's got a whole gang in Congress beating up on him. And he's got some people on Wall Street beating up on him, like Laurie Goodman, a good friend of mine, and some other people are all saying, my God, you've got to do this balance reduction. Well, if you read an article that's out that came out this morning when Secretary Geithner has proposed funding this sort of balance reduction for Freddie Fannie. I'm not quite certain whether this comes from TARP money or where the money comes from, but there's sort of a backhanded way of getting some money into Freddie Fannie. They can help them do principal reductions, but we haven't yet heard whether Ed DeMarco is going to go along with it yet. So this is up in the air, whether we do this or not. Again, if it does happen, I think principal reductions is one approach, but if you look at the data, and I can give you an article that was out this morning, and the evidence is not clear whether it really helps dramatically or helps a little bit or marginally, because you reduce somebody's loan balance, that doesn't mean they're not going to default. A lot of people who are having this problem are going to default anyway. So again, all these things put together, I think, will improve things on the margin. It won't impact those bigger numbers we saw earlier, like these 7 or 8 million people we're talking about, maybe we're talking about 500,000 or a million of them at the most. There's still many, many, many people out there that won't be touched by these programs. And the bigger problem is that as the government continues to pound away at the banks and the servicers and create more roadblocks, they just pull back from the industry, and there's less and less money available for financing. I think that is really the heart of the matter. And so on one hand, you have this crazy, crazy situation where you have Freddie Fannie still out there as the major guarantor for all the mortgages in America, except for FHN. I won't even go there. And so what's going on is, as they should, FHFA has put out a program to move away from total reliance on Freddie Fannie and move it off into the private sector. And they're doing a couple things. They're going to turn it into one origination platform, not Freddie and Fannie, just one new Fred Fan, whatever. More importantly, to drive it away from a public sector, they're going to raise the G fees so it becomes more and more expensive to go the way of that product. And so the goal of all that is to push the market away from a government program into more of a private program. On the other hand, we have these other crazy things going on out there. We have this idea that they're going to develop a qualifying mortgage, and maybe they won't give you liability relief from that. And on the other hand, you have the new consumer credit laws, which say you have to identify this person's ability to repay that loan. And if you make a mistake, and 2 years later he can't repay the loan, he comes back to the court and says, oh, I forgot, I have a sick daughter if I didn't tell the bank about, I'm going, sorry, bank should have found out about that, and they're liable. $70,000, $80,000, what the no? I don't know what the number is. Some big number. If this law goes into effect, no bank's going to write any loans whatsoever. Crazy, absolutely crazy. The settlement, the Attorney General settlement. We don't know exactly how many people will be helped, but I'll tell you who's going to get hurt. What they require now is the settlement requirements are going to that long-term trend line we saw on how long it takes to foreclose on loans. That's being locked in stone now because this is becoming now a rule which says you have to do step 1, 2, 3, 4, 5 to step 35 to foreclose on a mortgage. It's going to cost more. It's going to take longer. If you're a banker, you are going to loan to only one person. He's going to have an 800 FICO score. He's going to want like a 50 LTV. End of story. He's not going to be the average American. I'll tell you that. If all these things go into effect, which they are, it's going to face a mortgage originator. The only loans being written are going to be to the people who are really pristine, pure, etc. And do I have one second?
You have, well, 1 minute.
I have 1 minute. Okay. Also, along the same lines, it's just you read these things and you find it hard to believe. The Justice Department in the past 2 years has a new program. They're very proud of it, and they've talked about it. It's like 8 banks now. They've gone to and proved that these banks have originated loans in a discriminatory way. By looking at the data, they haven't proved there was racial discrimination or ethnic discrimination at all, but the data shows there's a problem. They've gone to these banks, they've reached, quote, another settlement. All these 8 banks have come forward. They're not going to spend the money to go forward. They've ponied up anywhere from 10 to 100 or $500 million because the justice has said you've discriminated against in lending. So on the one hand, you have everybody screaming, please lend money, and over here, you've got the Justice Department suing these people and extorting, no, I won't use the word extort, but at least getting money out of these banks that they're very proud of that because they're not lending in the proper way. So I think this is a lose-lose-lose situation. So yes, the housing market looks like it's kind of bottoming out. Until the housing finance thing gets straightened out, I don't think it's going anywhere.
Thank you, Tom. Mark.
Thank you, Alex. Yep. While we're getting the slides in order, just wanted to thank Alex. He's now writing a blog for me on nationalmortgagenews.com, and I urge you to read his words of wisdom. His last one was called Mind Your P's and Reg Q's. So I also want to thank him for plugging my book of poetry. I'm just thinking now that I'm proud that I wrote the first poem ever to be published in National Mortgage News, and Alex wrote the second one. To date, we've had 2 poems, so you've got the entire financial poetry world up here at the same time. So my brief was to try to look around and see if there was any market or niche that was showing some green shoots, and I did find one sort of. A couple of weeks ago, I was looking at some research from MBA. I noticed Jay Brinkman is here from the MBA, so I want to give him credit where due. And so I want to talk a little bit about the commercial mortgage market. Okay, obviously it's not as big as the residential mortgage market, but it's big. Approximately $2.4 trillion in assets expected by the end of this year, and growing. MBA thinks it's going to be $2.5 trillion by 2015. Now compare this to the negative growth in residential mortgages. There's now $9.1 trillion in assets, and that's down 10% from the market high of $10.1 trillion. So the commercial market is now more than 25% of the residential market. Now there's lots of differences between the two. Here's a real big one. One default on a single family mortgage is annoying. One default on a big commercial mortgage, and that can close a lender. We started out as National Thrift News, and I can remember back in the 80s when these little S&Ls with $200 or $300 million in assets would invest $100 million in a commercial project. Project went belly up, so did the S&L. So that's a cautionary lesson as to the risk. Okay, so who holds commercial mortgages? Commercial banks are the biggest, nearly $800 billion. CMBS and affiliated securitizations, $589 billion. Agency and GSE portfolios, $342 billion. Life insurers, $313 billion, but they also buy and hold some of those CMBS, et cetera, so their share is probably actually a little larger. Okay, here's a short history of the CRA niche since I've been covering mortgages, which is 28 years. And they do go through boom and bust cycles like residential. In the 1990s, there was a real big CRE bust. Life insurers were hurt very badly back then. But then, and I give them credit, during the recovery, insurers decided to get back in that market. In the 2000s, obviously, there was a bust which followed the residential one by a year or so. You heard Alex say the prices on residential peaked in 2006 and in commercial in 2007. So the bust followed the residential one by a year or so. So what is it looking like now? Well, perhaps commercial is recovering more quickly than residential. So here's some of the numbers. $230 billion in originations are estimated for 2012, $245 billion for 2013, $265 billion for 2014, and $290 billion estimated for 2015. That's a 25% increase. That's, not insignificant. What do the same numbers look like for residential originations? Just dead flat. All right, so the commercial mortgages somehow managed to avoid all the traps that the residential lenders did. No. Sector delinquencies are very high. CMBS 8.3, multifamily 13.3, hotel 10, industrial 10, office 7, retail 7. Those are still high numbers. So I guess that begs the question is, the commercial mortgage market, are they going to grow their way out, or is this a case of irrational exuberance? I'm not absolutely sure which is true. Multifamily market is doing pretty well. In the first quarter, the outstandings rose $4 billion, I should say, in the fourth quarter of 11. And for the full year of 2011, $16 billion. We just reported recently that the Federal Housing Finance Agency may spin off GSE MF efforts for cash. So that shows you that there's some thought that these are viable businesses. The closest CRE sector to single-family lending is multifamily. You can make a philosophical question on 2, 3, and 4 family homes where those units are rented out. Is that single-family or multifamily? So there's a little bit of blending there. Obviously, supply and demand, as home ownership demand lessens, the demand for rental increases. And as Tom mentioned before, we're starting to see now where servicers are starting to rent, or investors starting to rent vacant REO units, some of them to the people that actually defaulted on them because they can stay in them for a long time, as you know. and they just rent them back to the defaulted borrowers to get a cash flow going. So what are my takeaways from this? Well, despite the crash and the serious delinquencies, commercial mortgage lenders apparently are continuing to lend. We've seen that portfolios are projected to increase and originations are projected to increase. And another thing which I think is real interesting is the role of the life insurers, because they had every reason. They got burned very badly in the 1990s on commercial real estate, commercial mortgages, but they got back into the market with what they thought was stricter underwriting. So I think this is a good lesson for residential lenders. Okay, because as we're seeing now, there's a lot of timidity about lending in the residential lenders due to capital concerns, fear of regulations. Those are the biggest ones. But it seems to me, residential lenders ought to be getting over the fear of the non-conforming market, just as insurers got over their fear on commercial real estate and got back in. So I think the non-conforming market is the key to growth in the mortgage industry. We're going to always have some sort of federal agency, I think, but the private sector has been largely absent for the last several years. Obviously, we shouldn't repeat the horrible underwriting standards that was in the non-conforming market, but to avoid repeating the debacle that we went through. I like to look at the Home Mortgage Disclosure Act numbers every year. They're fascinating. There's 8,000 institutions or so that have to report, so it's an enormous amount of data. But one data point that I like to look at is unfunded mortgages. So in 2010, which is the last year that they've done, there was 2.6 trillion in mortgage applications, and 1 trillion of that went unfunded. That's almost 40% of all applications. That's a huge number. And in 2009, same thing, 1.2 trillion in apps went unfunded. So my question is, I think that not all of those were, not to be funded. So I think we're seeing somewhat of an underwriting overreaction. So let's say if loan review committees and lenders approved even 10% of those rejected applications, that'd be $100 billion in additional mortgages made this year, which would be about a 10% boost to the market. So and that concludes my presentation. Thank you.
Thanks very much, Mark. Chris.
Thank you, Alex. And let me thank you again for organizing these events. It's been a lot of fun. I'm very pleased to be here today. Before I go through my slides, I'm going to touch on the banking industry a bit, as has been my role in these discussions, but I wanted to answer the question about the housing market and also comment a little bit on some of the comments you've already heard. When people talk about affordability as driving a bounce in the real estate market, I think we have to remember a couple of things. First off, we have taken anywhere from 15 to 20% of potential homeowners out of the market. These are people who've had some sort of event in their credit history that essentially takes them out of any sort of eligibility for a loan. They're just damaged goods, and they will be renters for at least the next 4 to 5 years. They're out of the market. The other interesting issue is deleveraging. We hear constantly from the economists about deleveraging, and they look at the macro data and they say, oh, look, the line has gone down. But have we really deleveraged all of the households, or have we just charged off that 15 to 20%, and the remaining households that are still current on their credit still have very high levels of debt? And I think it's in fact the latter. So when you look at these statistics, you always have to step back and say, what am I really looking at? Let's go take a look at the industry quickly. Still weak in most states.
Did you read your title in case all of the people in the audience can't see it?
Bubble trouble, beginning of the end. Nope, sorry. And when you say sorry, you should do it with an English accent. Sorry.
Desmond can do that.
Right. Well, I can. I lived in London.
Okay.
When we talk about recovery in the U.S., and let's think about this settlement that we just had put in place for foreclosure abuse. Politicians are using foreclosure abuse as a means to gain office. generally speaking, the states that are lien states, in other words, states where you don't have to have judicial action to go and conduct a foreclosure if you were a secured lender, have been clearing faster. You can see this in the South, you can see it in the West, you can see it in California. It's not just that California is a very desirable place to live. It is. People want to live there. But it's also a state where you can mail someone notice and say, you're in default, get out. This is a big deal because the Attorney General in California, Kamala Harris, who just brought $10 billion back to the state, is planning on running for the Senate. She wants Dianne Feinstein's seat, and she would like to change California from a lien state into a title state. Now, who are the title states? The title states, if you go back to the Civil War, are the states, generally speaking, that were in the Union. The Union takes its legal antecedents from Old English law. And centuries ago, not that many centuries ago, it was almost impossible to sell a piece of real property. It was tied to your family. Even if you got the king to issue an edict, it was still unclear whether you could transfer the property. So if Ms. Harris is successful, she's actually going to shoot a hole in the bottom of the rowboat in California because the market is clearing in California. Creditors have rights. Now, here in the East, all of the judicial states after the Civil War, they didn't have to do anything. But why do you suppose the southern states all embraced the lien model? Because they had to attract investment. They had to be nice to investors during Reconstruction. So it's very important that you understand this, because when the politicians get up and talk about foreclosure abuse and they put in place these settlements, what they're really doing is killing the economy. And in particular, the Democrats, you know, they're the party of government. The way they justify their existence is by creating agencies and mandates. So you're going to see more of this. In fact, Massachusetts is thinking about becoming a super title state where it will be just about impossible for a secured lender to foreclose. That is going to kill lending in that state. It's going to kill investor activity in that state completely. If you look at New York, where I live, if you default and do nothing, you're looking at 4 to 5 years before they can actually get in front of a judge and get a judicial order that says, yes, that's your house, Mr. Lender. If you file an entry, if you actually hire a lawyer and just make an entry, you don't have to even file any motions, that'll add another 2 or 3 years. So we're talking about 6, 7, 8 years in New York. You can sit in a house and not pay your mortgage, and you're pretty much assured that you're not going to be thrown out of the house. Another big problem we have right now is the Fed. The Fed is helping us with low interest rates. As long as interest rates are low, the banks will hold on to their worst REO because they don't want to show it to you, and the cost of carry is 0. So if it's a commercial property, a little strip mall, maybe you have a couple tenants, the bank will sit on it. Why not? They love delay, by the way. Every time an attorney general wants to have an investigation, the champagne corks start popping because the banks benefit from delay. Now, let's talk a little bit about what's going on in the market today. We heard about the secondary market, how we want to see it recover and, you know, get investors back in. Is an investor going to come back into this market, conforming or otherwise, if people like Wells Fargo are writing loans that are half a point below where they should be? And I'm making a judgment here, but suffice to say they're rather aggressive right now. In fact, in both residential and commercial real estate lending in the East, particularly in the New York market, Wells Fargo's the only player. Citi, JP Morgan Chase, particularly Bank of America, have all backed away. They are refinancing their own portfolios and even some of their servicing portfolios very aggressively because they want to keep default rates down. But they're not out looking for new exposure. This is a very interesting point because the folks at Wells, by having that aggressive bid out there in the market, are basically preventing other entities from doing private label business. I was on a panel last week with the fellow from BlackRock who runs their conduit. And I said, why aren't you doing deals? And he said, I can't do deals because of Wells Fargo. Same thing with Redwood Trust. Some of you may have seen the jumbo deals that they're doing. They're losing money on every deal. They're doing it because they want to be in the market, they want to understand what's going on in the market, but those deals are very expensive. They're bidding against the big banks for that same collateral, and all the loans prepay. The average life of these deals is less than a year. So right now, there's not much for investors to do. And this is a big problem because if you think of the overall footprint of credit that's available to homeowners and to commercial developers, you have banks, and you have the private label market. The private label market is running off, and we're not replacing it. When that market runs off, it'll just be gone. And all you'll have left are bank balance sheets, insurance companies, your more traditional lenders.
Chris,
Yep.
you go back to that one and pick up your third bullet point there, if you would.
Well, Fed rate policy, again, is probably one of the bigger factors blocking the recovery of both the conforming market, which is operating at low volume levels, but particularly the private label market. Because if you have banks that have zero cost of funds, and in the case of Wells Fargo, they go out, write a very aggressive loan, and then they say, well, I'm going to sell Bubba 3.5 other products once I get him in the house. They will capitalize the estimated revenue from that customer in the same quarter that they made the loan. Does that remind you of anything? Maybe the internet bubble? They're the only bank that does this. The other interesting issue with them is that they now have almost 30% national market share. Think about that, one bank. There are an awful lot of community bankers who refuse to sell production to Wells Fargo, now servicing release, because Wells is so good at converting the customers that the community banker knows they're never going to get them back. This is a problem. The bankers are desperately looking for an alternative to Wells, but the other banks are not buying production. Bank of America closed down their correspondent business. Think about that. The other banks are all in single-digit market share right now. This is the ratings matrix from Institutional Risk Analytics. What's interesting, this is the number of units in each one of the ratings buckets. First quarter of last year was the best quarter for the U.S. banking industry. We've been going sideways ever since. We actually have fewer A and A+ rated institutions than we did a year ago. In an operational sense, if you focus on why this is, it's mostly charge-offs. Loss rates are still pretty high. And going back to what Alex said about the time it took to get through the 1990s, same thing here. We are seeing the same loiter effect that we saw in the 90s in terms of loss rates remaining relatively high for a while. And you have to also remember that we changed the accounting rules in 2009. This is the same group by assets. And as you can see at the bottom, there's a little blue circle. We had a third of the banking industry assets in the F bucket at the end of 2009. The fairy danced out on the stage. You know, Bob Hurst, the head of the FASB, of course, was the fairy. He waved his magic wand, and the next quarter, magically, we move almost all of those F assets, or about 2/3 of them, back into the middle of the distribution in terms of ratings. This was fair value accounting, a couple of other issues, but essentially we changed the way banks report illiquid assets. It has this is actually a major inflection point for analysts. You have to be aware of this accounting rule change because the numbers are not the same one period to the next. So just quickly, I'm going to go through some of these slides because we have housing slides at the end. Return on equity. As you can see, the industry's recovered a bit. The blue line is Citi. The red line is the large bank peer group. It's doing okay, but we're not going to go back to where we were. Going forward, the industry is going to be lucky to do double-digit return on equity. During the boom, we were up at 20%. And as I like to point out to people, these are banks. They're not supposed to do 20% return on equity.
Plus the 20% wasn't real.
No, it wasn't real. And let's remember, we mentioned this years ago in this very room. What was the best performing thrift during the boom? It was Lehman Brothers. And now they're gone. They're selling the book, apparently, that's owned by Aurora FSB to Newstar, who is a special servicer. And they're going to finally wind up Aurora, which has been operating in bankruptcy since the Lehman Brothers default. I think we're going to see a bankruptcy very soon with Ally Financial. My guess is that they're going to sell the auto business back to General Motors, as they should. I've been talking about this for years, other analysts as well. And then I think they're going to also sell the servicing book to Newstar, because it's a difficult book, a lot of special servicing required. And the question then comes, can we get the adults at the table, the creditors of ResCap, there are some direct bondholders of ResCap, and then the parent company creditors at Ally have to sit down and agree, because otherwise we end up in bankruptcy court. That may be what happens anyway. Gross defaults, as you can see, big improvement, much better than it was during the crisis. Citi peaked over 500 basis points of default combined for the whole bank. That's why they were rescued. When they started showing that kind of loss activity to Wall Street, the government had to intervene. You will notice in the Fed stress tests that we just ran, Citi catches up with Capital One in the stress scenario. That's not good. Capital One is 2/3 high-yield subprime credit cards, and the fact that Citi caught up with them in this scenario just indicates how much of a subprime book Citi really is. Wells Fargo was right behind Citi, by the way. So, look at that report carefully. This is loss given default, essentially charge-offs, less recoveries, much improved. We were up in the 90% range for all loans by banks versus all recoveries by banks. And again, I think it's going to get better, but I don't look for enormous improvement. I think this is going to continue to go sideways. Why? If you look at the financial statements of most of the banks, whatever they have on their balance sheet as far as REO, real estate owned, that they've taken possession of, they probably have at least that much in the pipeline that's caught somewhere between foreclosure and when they legally take possession of the property. Because remember, until they have legal title, it's not theirs. And the accountants don't make them put it on their books. It's out there in limbo somewhere, and they like it there. Limbo is a good thing right now. Exposure at default, this is unused credit lines. Very important. Most of the banks in the United States have pulled back the amount of credit they have facing customers, both institutional and consumer. They're afraid of default. Citi has always been the most aggressive because of their big credit card operation, but they also have institutional lines. During the crisis, or during the boom, excuse me, they had $2.50 in unused credit lines for every dollar of loans on their book, which was an outlier among all the big banks. Wells was typically 50 cents. The other banks were somewhere around dollar for dollar. All of them have big credit card footings. Now Citi's only $1.50. So what they're really telling you is they've pulled in their horns. They're trying to protect themselves from future default. Most little banks have none. If you look at any of the regionals, they tend to be very conservative on this because it's exposure. You wake up one morning, Bubba filed bankruptcy, and you have a loss. This is industry unused credit lines by category. I'm not going to spend time on this. This all comes from the FDIC quarterly, by the way. It's a great document. If you're following this, you got to read it. They also give you all the data in Excel spreadsheets, and it's fascinating to go through it and look at it. The only thing that's really growing, as Mark was saying before, is 1 to 4 family. Banks like that credit. They're writing those sorts of businesses. On the commercial side, we got to be really careful about talking about recovery because a lot of these deals are getting rolled short term. They're doing 2-3 year rolls because, obviously the prices have come down. So they'll literally just roll the credit at the old valuation for the building and leave it alone. They won't even wipe out the equity holders. And they're kind of, kicking the can down the road. So we're just as guilty as what Desmond was talking about before with the Europeans in terms of avoiding the recognition of loss. This is interest, non-interest deposits. Again, think about the big banks. They're awash in cash. So for them to just go out and write loans, whether or not they're economic or not, makes sense because they don't have earning assets. They don't want to buy treasuries. They don't want to buy agency paper because, as Mark was saying at lunch today, all that paper's rallied. The yields are very tight. In fact, a lot of the better run banks in the country are shrinking. Look at PNC. Great management team. They don't want to put their runoff in securities, so they're just letting the bank shrink. When PNC closed the acquisition of National City, they were bigger than U.S. Bancorp, and they're now back to their original pre-acquisition size. So that just tells you if you're really interest rate astute, I think, and you're also worried about future interest rates going up, and you don't want a lot of duration risk on your book, you're just letting your book run off. And again, that's not good for the economy. We create jobs in this country by growing credit. It's been that way for 100 years. And right now on net, I think we're still seeing leverage taken out of the economy. Are we done? Time.
We can wrap it up in another.
I'll wait for the questions. Okay. But you can go through the deck yourselves.
Thank you, Chris. That brings us to John.
Thank you, Alex. I apologize. I don't have a written summary, so I'll have to be crystal clear in my presentation. I take it, Chris, that at Tangent, Bubba is the equivalent of a Muppet at Goldman, is it?
No, Bubba's a customer. We love Bubba.
Well, never mind.
We never use
those terms. I want to talk about a little broader picture here. The title of this is Six Marches and a Seventh. That is, the first march I'm going to talk about is March of 2007, and then I'm going to march through the marches and use that to make an extrapolation about what March 2013 might look like. And I would do Octobers too, but I don't have time because I'll have to do that the next time. So let's go back. And my bottom line is, you know, it's been, the clouds are still swirling. I don't see us clearly out of this. And I'm going to deduce that from the remarkably difficult to read signals that we've seen over the past 6 Marches. If you think back to March of 2007, was that our first gathering? It was still 3 months before the Bear Stearns hedge fund, real estate hedge fund, mortgage hedge fund was to blow up. Blew up in June. And so the global debt crisis was a speck on the horizon to some, and certainly not something that was being taken very seriously in the marketplace. And so we were, that was the sort of, how shall I say, the calm before the storm, to use a term that's been used here. March of 2008 was substantially more interesting. That's when Bear Stearns crisis hit. Bear Stearns would have gone bankrupt had not the Fed allowed J.P. Morgan to buy them. AIG had to be bailed out by the Fed. There was a huge incipient panic in many quarters in Wall Street, especially those who were counterparties of Bear and or other investment banks. That said, and here's where the clouds begin to form, or the haze begins to form. By April, you know, the stock market was rallying again, everything was wonderful, and the feeling in the market was that we're out of the woods. Of course, what we were there to see subsequently was the summer, Fannie Freddie problems, Lehman blow up, and then the whole crisis that unwound there. And at the same time, late in 2008, China entered the arena with a massive stimulus package that was coupled with the U.S. first fiscal stimulus package, and early 2009 began to look a little bit better. There was a sharp rally later in 2009 after the cratering during the Lehman crisis. And I remember actually as we sat here in March of 2009, it was the day that the Fed announced that they were starting to buy treasuries. And there was a short celebration in the treasury market, and that marked actually the low point for interest rates for quite some time after the Fed's initial purchases. Not subsequently, but here again, you got the Fed getting into the business of aggressively adding to the size of their balance sheet. Move up to March of 2010, we had a pretty decent rally, remember, in risk markets at the start of 2010. There was a sense that crisis was over. But then, of course, Greece began to hit the headlines, and the whole European debt crisis that Desmond has been chronicling so well began to play out, and the struggles attendant on that crisis began to cause discomfort in the financial markets. And so here again, after having had a pretty good run in 2009, 2010 started off well, only to have the party spoiled by the spreading of the European debt crisis. Remember, however, that there was a solution to the Greek crisis, the first program. Funds were assembled, the whole Greek crisis was, quote, contained, and we moved on to 2011. In March of 2011, here again, we were a year ago feeling pretty good about risk markets. We had seen yet another set of stimulus policies. Remember, at the end of 2010, we extended the payroll tax cut in the U.S. We put together a fiscal stimulus that was substantial. The Fed was being accommodating. The markets got a nice boost. And then we had a set of exogenous shocks, maybe some endogenous, but we had the higher oil prices. Sound familiar? But that was, at that time, it was attached to the Arab Spring. This time it's attached to supposedly supply uncertainty, which is probably the case. Japan had their nuclear accident. And the Fed, I don't think Chairman Bernanke would be reminding us of this given the statements he's been making over the past week, but the Fed began to talk about exit strategy. It's time to think about how to exit these massive portfolio positions that they had gained in the process of trying to add liquidity to the banking system. So here we are now in March of 2012. At the start of the year, we've had a nice rally in the risk markets. There are some clouds on the horizon, which Desmond has reminded us of. That is, Europe is probably in a recession. The U.S., once again, at the end of 2011, reenacted fiscal stimulus after substantial hand-wringing about deficits and debt accumulation, and it peaked in the summer of 2011 with the rollover and the debt debacle, as it's called, in the middle of 2011, where the U.S. managed to talk itself from a AAA to a AA rating. But here we are now with gasoline, I should say, energy prices rising. Europe a little bit shaky, as opposed to last year when Europe was in considerably better shape. Remember, last year in 2011, we were still looking forward, I think, to 2 rate increases by the ECB in 2011. If you can believe that now, looking back, but there you are. Now we have Europe as a substantial drag. Another issue that I have sort of glossed over here, but it's been there all the time in the world's now second largest economy, China, which has been quite supportive of expansion since 29, at least in 2010 and part of 2011. Ran into an inflation scare, has begun to pull back. We're seeing now signs of a substantial slowdown in China. By that I mean 7% growth instead of 9% growth. House prices in over 2/3 of the Chinese cities surveyed over the past year have been going down. The Chinese banking system, of course, is exposed to this, and the solution will be that the Chinese government / central bank will simply eat the losses when the time comes. But the tailwind from China that we enjoyed through the 2009, 10, 11 period, at least the first 2.5 years of that 3-year period, has probably waned. In fact, remember that China, in its good years, accounts for something like, 40% of growth in the world. So if we have it accounting for a substantial smaller percent, the fact that the U.S. is going to grow at maybe 2.5% instead of 2% is nice. But certainly there are some legitimate questions as to whether that's going to continue. I add to that, as I listen to the presentations here, certainly on the balance sheets of many financial institutions, there's still quite a bit of churning underway, and certainly on the balance sheets of many U.S. households, there's some churning underway as well, tied largely to real estate losses. Another plus, or another boost that we've seen, if you look at it that way, is that all of the central banks in the last 6 months have apparently decided that we're not out of the woods. The Fed did QE2, and the Fed has talked about February 2014 as the time at which they may start to think about raising interest rates. That's controversial. The ECB, as Desmond mentioned, has done about €1 trillion worth of 3-year repos that will help to capitalize European banks. And even the good old Bank of Japan on Valentine's Day stepped up and said, we're going to add more to bank balance sheets, and we're actually going to target a positive inflation rate, which is the first time they've really been willing to say that. And I suppose, and I wrote about that last month, and I thought, hey, this could be something. It's certainly in terms of a yen weakener, but maybe we'll get a little pop in the Japanese stock market, which has been pretty much wrung out. But again, when I listen to the micro story about what's operating under the hood, when I listen to what's happening in Europe, and I look at the pace of the U.S. recovery, which is okay but somewhat shaky. I don't think the first quarter of this year will be much over 2%, and subsequently we have a problem. I don't think we're out of the woods. I would add to that at the end of this year, as you probably all heard ad nauseum, we have a fiscal pothole in the U.S. which is quite large, about the equivalent of 4 percentage points of GDP. That's really the integral of fiscal kick the can. Every time you do stimulus, you get a boost, and then when you take it away, you get a drop. Well, we've done a lot of fiscal stimulus, and we can't stand the drop, so we keep continuing or expanding the stimulus. And then if you pass a law that says it's got to end at the end of December of 2012, you hit a waterfall. So you've got currently legislated an end to the Bush tax cuts, an end to the extension of payroll tax cuts, an end to the extension of unemployment benefits, higher taxes on all income are part of the health care bill. That is for households, I think it's for households over $200,000. There'll be a 3.5% additional tax to finance Medicare. So you've got a fiscal shock coming during the lame duck period for Congress. We'll have an election in November. Somebody will get elected. Nothing will get done before the election. And so the economy had better be doing pretty well, because I'm not sure what a lame duck Congress will do with this fiscal waterfall that's coming up. So I guess what's March 2013 going to look like? I hope it's better, but I frankly, and tactically, I think most people in the marketplace are anticipating a better picture. That's why stocks are up by 12% already this year. But I have a feel that 2012 is going to, in terms of the way risk markets go, look quite a lot like 2011 and 2010, where you get a nice bounce, reality dawns. By the time we get to mid-year, we realize that nothing gets done about the fiscal waterfall probably until March of 2013, when whoever is the new administration will undertake it, because I don't see a lame duck Congress making landmark decisions on U.S. fiscal policy. If Desmond's right, we'll see sort of an ongoing fever level or a chronic European problem. China's, I don't think, going to be a vigorous grower. It'll be doing it 7 or 8%, but not doing anything additional at the margin. So I don't think we're out of, as I look at the last 6 Marches and look ahead to the 7th, I don't think we're out of the woods yet. That doesn't preclude, as we've seen all through this period, some very substantial rallies in risk markets, and people will be tempted to follow along with those, especially given that the central bank is in effect, most central banks are imposing a kind of fiscal repression of the type that Reinhardt and others have spoken about, where if you want to be safe and hold cash, you get a negative 2% return because inflation's 2%. And if you want to be wild and adventurous and hold 10-year notes, you get 0 return. So that tempts people to go into risk at a time when it may be premature.
Thank you, John, and thank you all. At this point, I want to just, we'll take the panel in the same order as we spoke before. See if you want to respond to anything anybody else said, to further elucidate something, and you can have a minute or a minute and a half if you want. Desmond? No? Tom?
Yeah, just one quick thing that Chris did note, and I'm glad he did. That one chart I had which showed the deleveraging of the U.S. consumer, and he correctly pointed out that a lot of that deleveraging was forced. It wasn't a matter of them voluntarily saying, I want to lower my exposure. They were just written off. They was defaults. I don't know what's half of it, but certainly I would guess maybe half of it is probably that is exactly what you were saying. So I appreciate that correction.
Thank you. Mark?
In terms of the Churchillian frame here, I would say it's closer to the end of the beginning than the beginning of the end.
It was a long beginning. Chris.
Yeah, I couldn't help but think about John's comment about Bear Stearns, where I worked twice. Our colleagues at the Fed have consistently failed to understand the operations of financial markets and how the role of credit operates in our society. This may surprise some of you, but it doesn't surprise me at all. I was among people, including our breakfast guests this morning, who went to the Fed in New York and said, look, we have a problem in the mortgage market. Pay attention. New Century Financial. A year and a half later, the Bear Stearns hedge funds fail. And again, they totally ignored the issue. So had they put in place the repo facility that they finally came up with, neither Lehman nor Fed, or nor Bear Stearns would have failed. They would have been financed, and that was the problem. Even today, the Board of Governors is pretending that we don't have a housing problem. Read Ben Bernanke's speech. Read the other governors who are out talking about housing like there's no problem. So I think we have a real issue here in terms of the role of the central bank. And I think, again, it shows us that we need to narrow their focus, leave them only responsible for monetary policy, and maybe we could let them take care of markets if we take everything else away from them, because they can't handle all of these different tasks. I think that's clear.
Thanks, John.
Nothing to add at this point.
Thank you. I mentioned we had a mystery guest speaker. It is Jay Brinkman, who is the head of research and chief economist for the Mortgage Bankers Association, and somebody deeply knowledgeable about mortgage markets. So, Jay, we want to, where's my microphone, please? Could you bring it over here to Mr. Brinkman? And I want to give Jay just a minute or two to give his idea on whether this is the beginning of the end or the bottom or something else.
Yeah, well, last week, I guess, Alex invited me over to lunch at the sumptuous AEI cafeteria. And, demonstrating once again there's no such thing as a free lunch. He then said, oh, by the way, I'm going to call on you at the session for a couple of comments. I guess the issue is, are we at a bottom? Are we seeing the bottom? What I've tried to explain in my view, where I often say national numbers dealing with real estate and mortgages are asymptotic to meaningless, that it's more like being behind the bleachers at a high school football game, that if you look up, you're going to see many different bottoms, and the particular bottom that you're focusing on is going to be where you're standing. And it's going to differ by where you are. It's going to differ by state. It's going to be differ by city. It's going to differ by subdivision within that city. So keeping that in mind, I wanted to mention first on prices. One of the things we look at actually is the core logic series. What's good about the core logic series, as apart from Case-Shiller, is that they break out distressed versus non-distressed sales. And we have been seeing an increase for some time in the non-distressed sales, continuing decline in the distressed piece, and the issue then in total prices is what is the mix in a particular market? That's really why we're seeing some markets go up, some markets go down. Keep in mind, Florida, one of the largest markets in the country after the '29 recession, didn't see prices recover really into the early 50s. So Florida has a history of being much more than 6 years. Again, it depends on what bottom you're standing behind in terms of measuring the market. The other issue, I guess, is in rent versus own. I'm officially agnostic. I represent multifamily lenders, as Mark notes, as well as single family. The key is going to be household formation. That's key to job creation. That's key to where the economy's going. That's key to what the impact of Europe's going to be on the economy going forward. There are many brighter minds in this room on those subjects than mine. We pretty much have to take the economy as given. In terms of where we are as far as a bottom sort of globally, let me point this out. When we look at the delinquency numbers, if you look at loans that are 30, 60, or 90 days past due, we're about halfway back to where we were before the recession. If you look at foreclosure starts, we're about halfway back. You look at the problem, which was Tom mentioned and others, the loans that are actually in foreclosure differs completely again by where you are. Chris mentioned the union states, the ones where you need a court action to force a foreclosure. Those inventory numbers continue to go up. The rest of the country, they're going down. So it's a government-inflicted problem, I think, and what's keeping some of this overhang in the market. Finally, mortgage availability. Mortgages are available, again, to credit-worthy customers, and don't forget the oversized role that FHA continues to play in this. We continually see FHA north of 40% of the applications market. The problem, of course, is not so much that default incidence is going to change. It's the cost of severity. When a loan goes bad, it is so much more expensive in dealing with that loan because of servicing, because of timelines, etc. That's what's tightening the market. Finally, I want to mention qualified mortgage. Chris or Tom, someone mentioned that. Yes, that is going to be a major problem if the CFPB regulation goes through, because that will turn every default into a legal action in federal court on top of the state court actions that we're already seeing. It's going to be a mess. So, Alex, thank you for the opportunity.
Thank you very much, Jay. All right, now we come time when you can ask questions. I want to remind you of AEI rules in this. Please wait for the microphone and then tell us your name and affiliation and ask your questions. And if you do have a statement, it will have to be short before your question. But any questions? Young fellow over here right by the microphone.
Thank you, Alex. This is first of all, my name is Bert Ely. I'm a banking consultant here in town. This is a two-part question for, I guess, basically Desmond and Chris. Desmond, coming back to the European situation about the lending and the pressure on the banks to increase capital, what is your sense of what the impact is going to be on not just the European banks, but on their capacity to lend as Basel III starts to kick in? And then related to that, to Chris, is you put up that chart about the ROE situation with the banks. Given that banks, not only in Europe but in the U.S., have to compete in the capital markets for equity capital that can be invested in any kind of industry, how can the U.S. banking industry, or for that matter, banks anywhere, be able to attract or even retain the equity capital they currently have when they are only able to earn ROEs that are below what they can earn in other markets? To express this as a concern, it seems to me that the combination of Basel III and its higher capital requirements kicking in with depressed ROEs over an extended period of time is going to lead to a decapitalization and therefore a shrinkage of the banking industry and their ability to provide credit. So what are the implications of that? And
Thank you. You cleverly got your statement in after your question. Let's start with...
I try to be clever.
Start with Desmond, and then we'll go to Chris.
No, I think that the capital shortage problem of the banks in Europe is a huge problem. And I think that one needs to look at it in terms of where it's distributed, that the fact that it's mainly distributed in places like Italy and Spain, and you're not getting cross-border lending, that is really problematic in that you're going to get the credit restriction in the countries that most need it, in terms of the ones that are applying a huge amount of fiscal adjustment. Currently, what you've got is, according to the European Banking Authority, they've got a shortage of capital in Europe of something like 115 billion euros. When you look at IMF estimates, they were more like 200 billion. I think that those estimates are understated because in addition to the sovereign debt losses that they're making, they're now going to be making losses on their other operations. So I think that this is a real problem going forward. And I think that what they're doing is they're asking these banks to raise their capital asset ratios to something like 9%, without telling them that, you've really got to raise the capital side as opposed to shrink the balance sheet. So I think that, you could see a very substantial reduction in credit from the European banks. This is going to have very big implications for credit reduction outside of Europe, because that's where they're going to start, is cutting back on their Asian lending, cutting back on their East European lending. But I think that that's going to be a huge problem going forward, this reducing of the balance sheet. So estimates that are floating around there, some people think that you could be seeing them reducing over the next 18 months their lending by something like 2 trillion euros.
Thanks, Desmond. Chris, on the ROE issue?
That's a very good question Bert asked, and it's one I think about a lot. If you think of Basel III and Dodd-Frank together, both of these regulatory efforts are going to do a couple things. First off, they're going to drive commercial banks out of the conduit business. Under Basel III, our good friends from the regulatory community went to Europe to negotiate with the Europeans, and Europeans don't like mortgage servicing rights. They put a lot of cats and dogs in that bucket, and they said, oh, these are bad. So the U.S. side had no brief. They didn't even respond until they got back to the U.S., and some of my friends in the mortgage industry started yelling at them, saying, look, you're going to have 100% reserves on mortgage servicing rights and not carry them on the book. The other thing, of course, is with Dodd-Frank. Let's think about the Volcker Rule. Under the Volcker Rule, we're not only preventing prop trading on the sales trading side of the house, but the chief investment officer at J.P. Morgan is no longer allowed to trade around his long-term investment book. What does he own? He owns bank, equity, and preferreds. In fact, he's one of the biggest holders in the market. I just hired one of his former employees. There's no longer any trading by the big banks around these positions. So I guess that we have lost about a third of the liquidity for bank securities in the United States because of the Volcker Rule. You put these two together, what does it mean? It means that you're going to have to regrow non-bank finance. All of the businesses that the banks bought during the boom and they thought they wanted to be in, they're now going to have to reconstruct non-bank financial companies to do mortgage aggregation and securitization and other types of lending that the banks just won't do anymore. Asset-based lending, for example. They're going to get out of that. Household finance, remember them? Bought by HSBC, destroyed, written off. So we're going to have to literally rebuild that sector, and that's an opportunity. But in the meantime, consumers and markets that were depending on the banks for this sort of credit are going to starve. And I think, we're going to have to come back and redo Dodd-Frank. We're going to have to look at the whole Basel III issue, and I think we should withdraw from Basel. I really do. I think it does not serve the interests of the United States to be part of the Basel Accord any longer.
Thank you. I had a question over here, and then I'll take the one in the back, then we'll come up to you.
Hi, Merrill Smith, Independent. For Mr. Zimmerman, you mentioned the failure of fiscal reform at the state and federal levels to keep up with private deleveraging. There are, of course, a number of policy advocates who think that's not a bug but a feature, in the sense that because the private sector is deleveraging, therefore the public sector should step in and make up that difference. Do you think the reasoning behind that is sound, or is it the fact that there is such a big hole of public debt and lack of reform that is in fact scaring the private sector into even more deleveraging? So it's actually a vicious cycle. Just two hypotheses. Which one do you think is more plausible, or come up with a third?
Well, those are great questions. I didn't mean to say exactly that the fact that the federal government and state governments haven't dealt with this is totally bad given where we've been the last several years. At some point, you got to turn this ship around. We were talking about, are we at the end of this thing or not? And the fact that these things haven't been turned around means we're not even close to the end. I guess that was my point. Not so much a policy point of view as whether it's totally bad or not. Is more to the, although personally I think a lot of it is, but I mean it from my real point was we're not near an end. I guess that was the biggest point I was trying to make. Now, from a policy point of view, you get the 20 smartest economists in America and put them in a room and try to figure out, is the European way, which Desmond clearly doesn't agree with, or the American way, the better way to deal with this thing in terms of a large credit bubble burst, and how do you deal with the aftermath? How long do you keep the loose monetary policy and strong fiscal deficits going to keep the economy going, and how do you wean yourself off of that and move into a steady state? You have 20 of the smartest guys in a room, and you will not come close to an answer. There is no way. It turns out to be, unfortunately, more of a political kind of a bias, which is not a great way for an economist or a scientist to think. But I don't know if anybody here disagrees with me, but I don't know what that ultimate best path is out of this problem. The macro guys can do that more than I can.
Well, we're going to find that at the end of the year.
No, this is very important. Keynes supposedly disproves Say's law, and he says that all that matters is purchasing power, and what matters is wealth creation. That's the opposite view of the conservative, free market economists. And this, I think we've reached the end point. That's why what you said is so important.
Okay, we're going to take you next, then I'll come over to your question here. While the microphone is coming down, I want to remind us all of one thing, that after the bust, all the losses economically have already taken place, but they haven't yet been recognized. And so what happens in the late phases, which is where we are now, is there is a vast fighting over who will take the losses. So the losses must be taken, but it's still not decided who is going to get socked with them. And you can look at all the lawsuits, the servicing settlement, the fights over foreclosures. It's all about distributing the losses, and that's a long, painful period. But I think it's helpful to understand that that's what's going on. A giant negotiation about who's going to get hit with the losses, which are unavoidable. But of course, each party would like to have somebody else bear the most losses possible. Yes.
My name is James Groth. I'm an analyst with the Reason Foundation. This question's for Chris. I just wanted to address your comment on credit creation and the interest rate environment. Would you argue then that the Fed raising rates would actually spur credit creation? If not, what type of policy would actually change that trend in credit creation at present?
I think that's absolutely right. There was a time when zero rates made sense, just as there was a time when all of the short-term liquidity efforts by the government made sense. We didn't want to have a meltdown. We didn't want to just have a fire sale. But I think we've reached a point, if you look at the chart at the back of my book on net interest margin, it's clear to me that the earning assets are falling now faster and faster. Remember, the average life of most banks' balance sheets is 4 to 5 years. So 20% of the book is rolling off every year, and they are repricing it at lower rates. You're also starting to see prepayments in these higher coupon Fannies and Freddies that Tom follows that were very low, but they're starting to be refinanced. They're starting to prepay. And so the banks, I think, in a year from now, especially the broker-dealers like Morgan Stanley and Goldman Sachs, are going to be in big trouble because they're not making anything off their inventory. There's no carry. The street cannot survive. And this rolls through to what we said before about the non-conforming market. You want investors to come in and do jumbos and do other types of loans that you can't put through the FHA. You got to let the yield curve go up a bit and get more spread. Then the arbitrage will bring them in, and you'll see BlackRock and all of the other non-bank players happily get into the market. And you will also see non-bank originators able to sell their loans to those non-bank conduits. That's how we fix this.
A comment from John, and then we'll go to Mark.
I think that's a good question of, should the Fed raise rates, and I'm not sure it's quite that easy. I think obviously as a potential lender, I'd be happy to see that happen. I'm not sure that borrowers would fare very well, and so I think it's if the Fed raises rates, then the dollar appreciates. A lot of nominal contracts would be disturbed. So I think that's part of the Fed's dilemma. I don't think it's that easy just to go out and say, let's raise rates. It would, as I say, lenders would be happy to start operating, but I think borrowers would
Half
be
a
struggling.
point for Fed funds. That's all you have to do, and then we have a repo market again.
All right, let me come to Mark.
I just wanted to make the point, that a lot of borrowers are effectively out of the market. If you have a 3.5% 30-year fixed rate mortgage, not a whole lot of incentive for you to refinance that. Unless cost of funds goes down to zero, so there's a lot of people that won't be, asking for credit because they're all, they've got 10-year, 15-year, or 30-year, 3.5% mortgages.
I have a question back. I'm sorry, you're next, and then I'll come back here. Yes.
David Forward, I'm a guest. To Desmond, you indicated that the euro is unraveling. And about November, I was talking to one of the high officials in the European Union, asked him if the euro was going to be unraveling and how about Greece and Portugal and all, and he said, no, it's the same thing as your states. There's no reason just because a state is in financial trouble for it to leave the dollar, and there's no reason for a European country to leave the euro. And subsequent to that, of course, we've seen Greece default, but they haven't left the euro. Is he right?
I think to be charitable, I'd say he was being disingenuous, in the sense that the problems that the United States have, they've got real problems, but they're a fraction of what the European problems are. So, for instance, if you look at a state like California, if you look at their level of debt in relation to California's product, California's got a debt that is 8% of California's GDP. That's very different from Greece, where you're looking at something like 150%. The same with the budget deficit. So you've got public finance problems that are of an entirely different order of magnitude. And the problem for the European states is if you try to reduce those very rapidly, what you're doing is you're cutting back on demand very quickly on a weak economy. Now, normally the way in which this is done, if a country gets itself into that difficulty, the first thing you tell the country to do is, do the fiscal adjustment. You need to do massive fiscal adjustment, but move your currency so that you can have an export boom that offsets the fiscal withdrawal so your economy doesn't collapse. What they're doing in Europe is they're letting these economies really collapse. Now, if I look at Greece, the reason that I don't think Greece can stay in the currency union for a long time, because if it stays, what they're doing is they're in this vicious cycle where they've just got to keep doing more and more fiscal restraint. Their economy has already declined 16% from its peak. They're already at 20% unemployment. So the prescription that the IMF and EU is offering Greece is not only have we got you in depression, but we're going to deepen this depression and we're going to keep you there for the next 10 years. Greece's only hope is getting out, letting the currency move. They need to manage the current move to a new currency well, because there are risks that they go off to hyperinflation if they don't manage it well. But there's no way that these countries can stay. So I'm thinking that the euro is going to unravel if you define unraveling, meaning that several countries are going to leave over the next 2 to 3 years. And I'd put in that category, I'd put certainly Greece, I'd put Portugal, I'd put Ireland, and I'd put Spain, and Italy would be a question mark.
Thank you. I have the question back here, please.
Thank you. Valerie Rouxel from the EU delegation. I work for the European Union. I won't make any statements because you'll understand that I might disagree with Desmond. I have 2 questions. The first one is for Tom Zimmerman about the housing market and the linkages to the labor market in the US. I've heard Chairman Bernanke speak on Monday, and he was saying that there was no evidence of a link between the weak housing market and the weak labor market, although there's, I guess, plenty of anecdotal evidence that this might be hindering a pickup in the labor market, given that you need a flexible labor market, and everybody knows that the US labor market, being more flexible, has always rebounded faster than anywhere else, and it usually drives the recoveries. So I'd like to have your take on that one. And then my second question is about the fiscal waterfall. Are there any chances of muddling through all these fiscal deadlines that are looming at the end of this year? This is a question for Mr. Mackin. Because we have this massive fiscal drag that is looming for 2013, 3-4 percentage points of GDP, if nothing, under current law. So what is the most likely scenario? Is it that in the end, they'll pass through these extensions and carry them through to next year? Or is it something different that might happen?
Great, let's take those in order. First, Tom.
Yeah, there was a slide that I had in this deck that I took out because I tend to put too much in. And it was a presentation done by NBER economist at a Fed-sponsored monetary policy meeting in February of this year, and I can get the link for you if you'd like. And in it, it was that discussion of how important the housing market is to the overall economy. And for one thing, housing is very, 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 very cyclical, extremely cyclical. And if I recall correctly, in a normal recovery after 10 months, the housing market, whereas the GDP has increased by 11%, the housing market has increased, private investment in the housing market has increased by 35%. In a sharp break, like we had in 75 and 84, I forget the GDP number, but the housing market was 65% of a rebound from the bottom. Very cyclical, drives a lot of the economy, very important to the economy. There's a little bit of a problem with chicken and the egg, which leads first, the economy or the, I don't know how to sparse that up apart, but the same set of economists then took a look at the current recovery versus the average recovery. Average recovery was 11.5% after 10 months in GDP. This one was like 5.6, no, it was, the difference was like 5.6, I'm gonna get it right. This recovery is 5.6% behind the average from a normal recovery. Of that, they would attribute at least 1.6 to housing, and housing related another half or so percentage points, i.e. about half of the lack of this recovery was due to housing. Now, there's no question it's a very important part of our economic system. Now, chicken and the egg, which comes first here is a good question, because I recall looking at the two breaks in the California housing market, one in the 70s, one in the 80s. This was back in the old days when we really worried about what was going to happen in our economy before it all blew up. And if you take a look at the unemployment numbers in California, those two big recessions in California, and look at the housing market at the same time, they're simultaneous. You can't say which went first, the break in the housing market or the break in the unemployment numbers. So that's the data that I have.
Thanks, Tom. Yes, go ahead, Mark.
On that one, one of the big drivers of employment, housing related, is the new home market, because you have to build the new houses. And the new home market by far has been the worst affected. So, you know, if we were to, see an increase in new homes, you'd see more construction workers hired, you'd see a bounce that way.
John, you want to take the fiscal problem up?
There are two parts to the question. The first, is there any way to finesse it? And the answer is not under current law. That is, these are the fiscal waterfall is currently legislated, and so it requires an act of Congress approved by the president in order to change it. What will probably happen? I think a shortened kick the can episode where the lame duck Congress will gather and simply say, well, we're going to talk about this in effect in March, because that's really when the Congress, February, March, when the Congress gets back to work. So by the time it's March of 2013, we will be probably in the throes of dealing with that problem.
Thank you. Any other questions? Wayne?
Thank you. Wayne Abernathy, American Bankers Association. I believe my question would be for Mr. Macon. Alex has demonstrated we had a series of bubble burstings, 3 by your count. I'm wondering if there might be a 4th, that being in Treasury securities, yet to burst, but a bubble that's being built up there. And if so, what would be the signs that there was that bubble was actually deflating?
I just jump in there to say I just found this great quote from a leading bond investor in 1912, which is, nobody in his right mind would buy a Treasury bond to yield only 2.5%. Go ahead, John.
Yes, I'm reminded of the 6 Marches syndrome. That is, I recall it was a year ago when, approximately a year ago, when Bill Gross of PIMCO preordained a very bad year for his bond fund, some of which I own, by saying that the Treasury rally is over and I'm getting out and going somewhere else. And then, of course, we had one of the best performing assets last year was the 30-year bond, outdone only by the TIPS, which did away with the inflation risk, and of course people are paying to own TIPS, in a sense getting negative real returns to own them. So, and as one who long tried to short the JGB market with debt to GDP ratios now approaching 200%, but when they went past 100%, and that market just didn't go down. So as an investor, I treat that question with great caution. As an economist, I treat it with great, how shall I say, in a very humble way, because apparently nobody knows how to call the bond market, and calling a bottom in yields is very tricky indeed. That said, I'm guessing that well, there's a catch-22 here. Let me lay out a plausible scenario where you should be buying bonds today. Let's suppose that people get more excited about the recovery, and interest rates on 30-year bonds, which have gone as high as 3.4% this year, go to 3.5%, and that causes the stock market to drop rapidly. And insurance companies, which have long duration liabilities, are concerned, and inflation starts to slow down, then there'll be another rush back into the bond market. So it's a very tricky place to be, and I'm just going to say flat out, I don't know how to call a bottom in yields. But then neither does anybody else.
Anybody else want to talk about a bubble in government bonds? In American government bonds, because we saw it in European government bonds.
Well,
Chris,
it's not so much the bubble per se. I think you have that quality, but remember, these securities have no cash flow. They're very volatile. So a lot of investors don't realize just how much these markets will move compared to their perception of treasuries. These are all zero coupon bonds or very low coupon, lots of duration risk, to John's point. And yes, insurance companies will buy them, but the little bankers out there who are all running totally unhedged, to look at that chart, they want to maximize net interest margin. They're not going to spend money on a hedge. So if the bond markets do move, you could see financial institutions taking very large losses simply because they can't anticipate how much those bonds will move in a given period of time.
No, I'd just say that what transpires in Europe is going to have a big bearing on what happens to the US bond market. If my scenario plays out, that Europe is in real difficulty by the fall, what you presumably get is the same flight to quality that we've seen each time. And as it's not a question that U.S. Bonds are necessarily objectively, on the basis of their fundamentals, a great place to be, but as a safe haven, you'd really want to get out of them from Europe. Particularly if you're going to be getting the euro depreciating quite a lot. The ECB trying to get the euro at a lower level.
We're getting down to the end, Mark. I'll give you a chance for a final shot, if you have one, on any of the topics we've taken up.
Just wanted to say that I agreed with Chris when he was talking about banks not taking the losses on the commercial side and rolling them down the road. I think that's quite true.
Thank you, Tom. Final thought?
No.
All right. Well, my final thought is that this was a great panel, and we thank you all for coming, and let's show our appreciation for the panel.